In this episode of Common Sense, we're talking about stocks versus bonds. Welcome to YCG, where we help your capital grow. If that's something that interests you, then hit the subscribe button and bell notifications so you don't miss a thing. I'm Brian Yachman, President and Chief Investment Officer, and I'm joined by Elliot Savage, Portfolio Manager, and Will Kruger, CEO. Welcome, guys.
Hello. Hey, great to be here.
So really quick, we just want to make sure that we're all on the same page. Talk to me for a second about stocks versus bonds.
Yeah, well, stocks are essentially just an ownership position in any business, and there's no set duration, so it's just an infinite duration asset where you're owning the business for a long time. Bonds, on the other hand, are essentially just loans, and so the bond could be a loan to a government or to a corporation, or it could be a loan collateralized by some assets, and it generally has a fixed duration. And essentially, if you kind of step back, it's really just ultimately a claim on the currency of the country, collateralized by some other asset.
Right, whatever it's denominated in. Okay, so bonds are essentially, you're a lender. Stocks, you're an owner. Any other basics we want to cover before we move on?
I mean, I think you're looking at interest rates, credit risk, and duration, right? So interest rates, as they move up and down, so if interest rates go up, your yields are going to go up. And so therefore, the demand for those bonds increases. And so the price of those bonds is actually inverted, so it goes down. And as interest rates go down, less people desire bonds, and so the prices go up. And so there's that inverse relationship. I think you also got to look at credit risk too. So whether you're looking at a country, whether you're looking at a business, obviously the more bellwether the company, or the stronger the economy for the country, as credit risk increases, or as credit risk decreases, I should say, if there's the strength of an economy, then interest rates are going to go down. Whereas you want to get paid more if you're going to take on more risk of a company or a country. So there's that inverse relationship that people have got to remember. And again, I don't want to bore too many people, but we understand how bonds work. But duration is a big deal as well. So the longer you go out, investors want to get paid more. And so obviously you get a higher interest rate the longer the maturity, or the time of when you actually get your payment back after lending it. And then obviously the shorter the duration, the less you get paid as far as the yield or an interest rate. So that's kind of some bond basics to remember for those of you who are not so familiar with how bonds work.
Right, and I want to just clarify that one point about with the interest rates, that if rates are going up, if I already own a bond that's at a lower rate, if rates are going up, then that's why my bond price has to go down to make my bond more attractive.
Exactly.
And so, there's that inverse relationship. And then, as you mentioned, credit risk and duration risk. Those are all things that play into interest rates. So, or that play into the rates that are set on bonds. Okay, so those are the bond basics. But in a nutshell, bonds, you're a lender. Stocks, you're an owner. Then tell me, let's talk about these two asset classes. Which have performed better over time?
Yeah, well, so stocks have performed way, way better over time. Again, with stocks, you have an ownership share in the growth of the economy, as opposed to, again, a loan, which is just kind of at a fixed rate over a fixed period of time. And that compound, that higher return that you earn on those stocks, as long as the economy is continuing to grow and productivity is continuing to go up, that compounds on itself over time, and it results in incredible differences over very long periods. And so we have a chart here that shows from 1900 to 2017 that long-term government bonds went up in real terms by about 10 times.
Right. And so $1 basically grew to $10.
Your purchasing power grew about 10 times.
Or went up 10 times.
Right. Yeah. Whereas with stocks, your purchasing power grew over that same time period over 1,500 times. So I can't remember 1,000.
What was that number? 1654.
Yes, 1654. So just an amazing amount. And so
it's not even close.
Right. Yeah. It's many multiples. And that's that, Einstein quote, at least it's attributed to him, that compounding is the eighth wonder of the world. And you really see it with those stocks versus the bonds.
And I'd also point out that the dollar that went up 10 times with bonds, neither of these numbers are factoring in taxes, but bonds historically tend to be taxed at a higher rate. And by the time you have stripped out inflation and taxes, it's almost like you've been on a treadmill on bonds, whereas with stocks, you still have increased your purchasing power multiples of times. So now you might say, well, that's just a U.S. phenomenon that you're showing in this chart. What about around the globe? How have stocks fared versus bonds?
So you take a look at this, and 5 countries experienced negative returns, compared to the 21 countries that you see here, and stocks have overwhelmingly. They've all been positive in every single country. So it's not just the U.S. phenomenon, it's worldwide, looking at that range of time.
Yeah, in every single one of those cases, stocks have handily outperformed bonds and bills. And so it's been almost a universal, historical fact.
So now a lot of times people talk about bonds being viewed as safer or less risky. And so I want to ask the question, are there risks to bonds, or what are those risks?
Yeah, I think there's always risk when it comes to investing. Nothing's safe. We got to think about what are our risks. And, I think when you look at bonds, we talk about the credit worthiness of a company or of a country. And I think we take for granted living in the United States, living in an economy which is so robust, but yet we still have risks as a country and an economy as well. So there's always risks. You can lose money, as demonstrated by those 5 countries that experienced those negative returns. And so don't equate a lack of volatility to, there's no risk here. And I think that's the key component where we're talking about purchasing power. It's that silent killer, right? And you've got to remember that there is risk of a losing purchasing power. And so in our thinking, that's risk. It's not achieving your financial goals, and not thinking about kind of those things like inflation that can eat into your purchasing power.
Yeah,
and
you're
I would
reminding
just add.
me. Oh, go ahead, Elliot.
Yeah, I would just add to that I think that's a great point, Will. And I think the real best example from history that shows this fact is the Weimar Republic in Germany after World War I. And essentially, there was such a hyperinflation that people were kind of had wheelbarrows of currency that they were wheeling around because it was worth almost nothing. And again, as I had mentioned at the very outset, bonds are at the very end of it, ultimately a claim on a currency. And so if the currency becomes worthless, then the bond becomes worthless. Mm-hmm. And that's what you saw in the Weimar Republic. As opposed to if you own a business, the most important thing is that business still valuable to society over time? And if it is, it doesn't really matter what happens to the currency, because people will be willing to pay some of their output in exchange for that product or service that society values. And that's why stocks are much more robust against something like a hyperinflation than bonds.
Right. They're more adaptable to whatever currency is going on at that time, whatever you're trading in.
Right.
When you bring up the Weimar Republic, you just reminded me, my dad told me about someone that he had known that they paid off their mortgage with a postage stamp. So it goes to show you, as the currency continued to inflate, it got to the point where a single postage stamp, because the mortgage was a bond, essentially, it's like a debt, in the past priced in old times. And so it got to the point where he could just pay off his debt with a stamp. Well, imagine if you're the bondholder and you're lending money and you get paid back a postage stamp. That would be awful. So, and you might be thinking, well, that's only forever ago. But, this has even happened recently. When I say recently, in the 1980s, there's an example of treasury bonds that were trading 40% lower 1 year later. So you don't even have to dig back that far to find out that it can happen, even in some more recent type of times. So then why are they so popular in retirement? And what are our thoughts there about using bonds as a tool during retirement?
Well, I think academia has long taught, the older you get, the more bonds you need. And I think it comes down to this volatility question, right? So the older you get, you don't want volatility. And so you go for the lower return asset class because then when you're in retirement, you know that you're going to have your money there. It's not going to be subject to volatility or loss where you don't have enough time to make up for those losses. So I think that there's a reason why it's so popular. But I think people need to remember that technology, healthcare, it's improving. We're living longer, and I think people are underestimating the length of time that they will spend in retirement, and they probably also underestimate the costs with regards to healthcare. The older you get, you're going to require more medical treatments and things like that, and so you've got to be really careful. Again, trying to preserve that purchasing power. And so I think that's why it's popular, but I think we've built a case here why you want to remain invested in equities and be able to preserve your purchasing power.
Yeah, and as you say that, I like personally the approach of, it's kind of like the barbell approach of if you know you have a long time horizon, then pile into what has been viewed as the best performing asset class that's been shown to protect your purchasing power, which is stocks. And then on anything that you need in the short run, I like the idea of that's what you would be putting into bonds as a form of protection in the short run.
And I would just highlight actually probably not bonds, T-bills, so very, very short term. Because,
that's true.
Because bonds can change in value a lot in long duration assets, whether they're bonds or stocks, can change a lot depending on the prevailing level of inflation and interest rates.
Yeah, and thank you for clarifying.
And I think with this, you need a financial advisor to help you, and we're more than happy to chat with you. We'd love to actually hear your comments on this particular topic, why you like bonds. Leave them in the comments below. But I also think you brought this up earlier, Brian, but taxes is such an important thing to consider. And the income that you get from bonds is taxed at your income marginal tax rates, whereas stocks...
Every year too, right?
Exactly.
Every year, no matter what.
Yes, the interest that you're getting, it's considered income, whereas the capital gains that when you sell a stock is obviously taxed very favorably and a lot lower than those income tax rates. So, especially when you're in retirement, you got to consider taxes as that real drawdown on the value of your portfolio. You can't ignore it.
Awesome. Well, thanks for tuning in for this episode of Common Sense. Check out our other videos and we'll see you in the next one.